Ladies and gentlemen of the crypto space, we're live on a Wednesday, May 24th at 1:17 p.m. The return of the midweek stream. Because that's where we are in the markets. Things are happening constantly, and obviously, folks may think this is an indication of bullishness. While I do have the overall sentiment that this is the place to be, the last thing I am right now is bullish. Note that I've changed the stream image to the architect, so maybe the captain will become the architect instead. So that's an interesting thought. Not necessarily this imagery, but I've been going with it and thinking about it. We are in a precarious time. The resolution of the debt ceiling will produce a very large capital raise by the U.S. federal government. It's a capital raise, just like any corporation issues bonds. The U.S. will issue bonds, which will draw a huge amount of capital out of circulation, and it'll probably come from primary dealers, which will really contribute and hit hard to domestic liquidity conditions. Pop it over to the main screen, and you'll see what I mean. Domestic liquidity conditions, USM2 is obviously significantly on the decline, and domestic proxy liquidity conditions as measured by the Federal Reserve, the reverse repo, and the Treasury general account are getting hammered as well. The indication of moving averages, it's irrelevant. What's pertinent is that this has a directionality, not in the direction that's consistent with asset price inflation. The system is in full-on deflation, currency deflation, liquidity deflation, consumer price deflation month over month, and obviously the narratives are all skewed. The regulators and the bureaucrats and the podium talkers have the general public thinking about consumer price inflation, and there's going to be a complete misunderstanding, as always, by the general public over when things get better, because prices don't go down. Prices remain. If you have 0% inflation, the prices don't change. And wages have to catch up, which means people have to be hungry, which means people have to seek raise from their current employer and or a new employment elsewhere. So that kind of sucks. This is heading to one direction, and that direction is the continued gutting of the middle class, because most people don't have a capacity to seek upward mobility with regard to compensation. It's the minority that know how to ride the wave or climb the ladder and haggle with their current employer or negotiate with new employers. And therefore, the few can keep up with the consumer price inflation that has occurred thus far. Now, which brings us to, can the system handle deflation where prices come down on goods and services? You would have to inspect, obviously, the debt construct of individual corporations, and I'd be very interested in like food suppliers, and they're probably in a shit situation with regard to their daily credit requirements to meet capex needs like employment. That's a very precarious situation if the prices of goods and services go down. While you might have an increased desire to consume those goods from a supermarket, the general public is cash strapped. There is no liquidity with the general public as compared to normal times, as compared to historic savings rates, especially as compared to 2020. The liquidity is gone, which means the whole system has entered, you know, a directionality that's not leading towards favorable events. Now, the way my mind works about this particular directionality and situation is that directionality continues. It doesn't just spontaneously reverse. It's not possible. Now, historically, prior to '08, especially even more so prior to 2000 or the 2000 period events, they tried to let the system be a little bit more organic, actual capitalism, where you could have big bankruptcies and The system fails, and then the system stabilizes because once prices get cheap enough, free cash steps in and buys the assets, buys the companies, and you create a new base, and then the system cycles up as things stabilize over the coming years. I think we're past the point of no return where there's how the hell is productivity going to increase from where we are? So this is NASDAQ, so that's inflated, but let's look at the S&P and let's zoom out bigly. So the fall for a return to normal, for a return to where the system is priced based on a significant reduction in available currency, available liquidity, the system won't survive that. You wouldn't have supply chains, you wouldn't have retail stores, you wouldn't have a good portion of the banking system. And you'd have utter destruction on market prices of these asset prices. There goes pensions. Once you got pensions out the door, fixed income is going to be a catastrophe for the retirement community. Folks that are dependent on income from their assets to finance daily expenses. Old people. This would be an absolute disaster. So, and this is what Luke Groman talks about. There's no way out but to refinance current debt obligations, which implies a significant reduction in rates such that the refinancing can occur at a serviceable rate, and adjusting vis-a-vis intervention systemic liquidity conditions in the financial economy, which is not the real economy, which is not circulating currency units, which is bank reserves, intrabank money, the amount of capital that circulates vis-a-vis primary dealers, those types of market actors. The financial economy that doesn't reach consumer-facing goods and services. So if the liquidity, you put $1 trillion into the financial economy and it's not being used to purchase food at grocery stores, you don't have the effect of consumer price inflation, but that capital ultimately has effect on asset price inflation. And that's what we've seen. That's what we've always seen. That's what every country that we compare to sees. You see the most profound inflation in asset prices when you have significant currency inflation, even if that currency is not exposed to the general public, which obviously suppresses consumer price inflation. And ultimately, where does that lead us? That leads us to disparity, where the persons with the assets have significantly more capital than persons that don't have assets. And that's what we see in those charts, where the vast majority of the country owns the assets. So if there is no financial economy, there is no real economy, because if there's no financial economy at this point, how do you get the tax receipts to service the debt construct at a sovereign level? Is it going to be from manufacturing, a boom in productivity? That would be the organic resolution to this type of situation. And I just don't see that. Not without complete maelstrom, a tsunami wiping out significant part of infrastructure and industry to the point where the capital in the financial economy will buy up cheap distressed assets for representing enterprise that is exposed to the real economy. And the discounts required compared to where we are with the P&E ratios, it's just would be destruction. You're talking about like a mean regression to the 100 SMA on the 6-month on the S&P. 1100, 75% crash in the S&P. BlackRock, Blackstone, they're going to be buying everything. Anyone with cash is going to be buying everything. So that's where we are. That'd be an absolute. Then you don't have the tax receipts. If the prices on this chart, the price on this chart collapses like that, the whole system doesn't work. And there's one thing I know, human beings are programmed with a concept called flight or fight, and everyone is defensive. Just note that in your own conversation with other human beings, everyone protects their own interests. Everyone expresses defensiveness from time to time. I sure as hell know my wife tells me, stop being defensive. They're going to defend their political situation, their political job, role, career. And to do that, they need to protect and defend and maintain the retirement community. Because who are these politicians catering to? The politicians clearly aren't catering to millennials. I mean, some of them maybe, the minority, but the vast majority of politicians are catering to 50 plus, 60 plus. I mean, we'll just look at the way they talk and how they talk. They don't talk as if they're talking to millennials, actually competent persons. The vast majority of our political composition offers a very layman's presentation. So that's my sentiment. If they're not catering to millennials, they're catering to the older generation that's looking forward to a luxurious retirement where assets finance daily expenses. This construct that you're seeing on the screen in bar form, candle form, can't unwind. It can depreciate, but it did depreciate. Look what it did last year. So we'll see, because obviously resolution of the debt ceiling is the capital raised by the Treasury, and that's going to drain what, 700 billion, $1 trillion of liquidity. That's obvious what that's going to do to financial markets, but they can't do that to financial markets. Otherwise, the political, what's the word when there's turnover? Well, turnover. The political turnover will be massive, and you'll have literally like a political revolution where new ideas and frankly radical or progressive, populist, and that's why we're in this type of situation, and that's how populist politics emerges. So, who's in the stream today? We got Dan. Scrolling up. Critical Mass. Tapsy. Ding, ding. Wednesday's back. Killis is the house. Good afternoon. Jesse, Paul, Random, what do you think about Google CEO saying that quantum computing will make all encryption null and void within the next 10 years? We'll see in 10 years. That's about it. It's not a simple answer because you could have big numbers that you just make the number much bigger in quantum computing. Numbers are funny like that. Math is funny like that. So you could do very interesting things to accommodate even quantum computing because math is infinitely scalable. Imagine a seed phrase that isn't 24 words, but it's 10 to the power of 60 words. And instead of 5,000 words to choose from per word, it's 10 to the power of 50 words, or combinations of letters and characters from a selection list. And, quantum computing, it doesn't produce a solution for, I would imagine, a large enough number. We're still working very small compared to where things can go with the numerics, which is completely unbounded. June 1st, Jesus Christ. You know what that implies? That they needed to drop, the price needed to be cheaper to entice people to buy it. That's lack of demand, As Jeff Snyder talks about, when you have people buying T-bills at 0%, they had to scramble for collateral. 7%? That's the antithesis of a scramble for collateral. That's a complete absence of buy pressure of demand. That's wild. But we'll see. I mean, it's literally days away. We're getting close. We're going to have more information. We're going to be able to make an assessment of what the hell is playing out. And once we have some additional information, we'll be able to make some projections about where things are heading. And we get to measure the effects of policy change and current events on directionality. So it's imperative to be very careful in this market. There's nothing to do, which is basically the behavior that I've been executing for all of 2020, well, at least especially the end of 2020, where I committed to my narrative to execute in a particular way. And it's just been sales until then, income on a weekly basis. And you can't buy any of this stuff. You can't. Um, it's just too uncertain of a macroeconomic backdrop. You think a discount is a discount? A discount is a discount when you see a ridiculous mean regression on the monthly of the S&P to 3,000, a 25% haircut, and that's going to get every regulator's panty in a twist. I mean, you literally see it hit the 50 SMA again, or the TWAP down here. TWAP's not on the screen. Or the we're above the TWAP. See, that's why it's so conflicting. Now, bear in mind this is very consistent with the traditional, return to normal type positioning. So that's everyone's expectation, but liquidity conditions are telling a very different story. Now, bear in mind, we could see a softer than better than worse experience in various markets, especially the smaller markets. Like the only reason you have significant capitulation to the downside is if there's forced selling. Now, if you go over here to liquidity conditions, there's been some decent liquidity inflow into crypto markets, particularly Ethereum mainnet. If you go over to mainnet, if you eventually go over to mainnet, liquidity conditions have been positive. And you had $1 billion flowing on the 18th. Marginal outflow, 100 million, 250, but you had $1 billion of capital inflow. We haven't seen that kind of capital inflow since March. About 2-3 months. 1.6 billion, and that was some nice flow in December. Ooh, they caught the lows in December because, really October. Was some significant lows, but $2.58 billion worth of capital inflow. So, I expect, frankly, crypto markets to be relatively soft in depreciation as compared to other markets. Clearly, psychology indicates fear spreads from market to market, but the liquidity conditions is such a relatively small market, $70 billion, there's a significant capacity for capital inflow from anywhere. The amount of currency units in the system indicates that you could literally have a 10% increase in the amount of liquidity in crypto markets while US M2 continues to significantly decline because that's how small the crypto markets are. And all the crypto markets need to do is depreciate less than other markets, decouple, as folks have talked about forever. And that would be enough to psychologically indicate that there is strength here, there is sticky capital here, there's capital flow, velocity, capital churn, so on and so forth. And now you have a market that's outperforming. And that the destination being the crypto markets means that capital, that liquidity, could come from anywhere on the planet. Now, bear in mind, this is global liquidity conditions. Been trying to get dollar denominated. I believe this is dollar denominated, but I don't think the total is right because I'm doing a multiple of the ratio of dollars to the respective fiat denomination. I have to think about how to best sum this, but generally speaking, it's up. So, which means capital inflow could come from outside the U.S., dollar denominated or anything denominated, and put buy pressure on various assets, native assets to the crypto markets, which this contributes to the overall liquidity condition, and that liquidity spreads and has effect on various denominated pairings with such things as like WBTC from an Ethereum perspective, or Ethereum USD, Ethereum EUR, Ethereum JPY. On centralized exchanges, obviously those fiat currency pairings exist, and it will have an effect on the overall liquidity of these crypto markets. So Jesse, 7%, Jesus Christ. You're gonna wanna buy the stuff because we've been talking about great things, interesting things, exciting things from a future perspective of where things are heading, the significance of these tools and utilities for credit, credit, permissionless money printing, which is credit. And that's extraordinary. It changes a lot. But when the overall liquidity in the system is deflating, we're in a deflationary environment, it's dangerous with regard to price points, patience, macro. Everybody is bearish. That's actually bullish somehow, but I also can't see it. I certainly see it. So what is my sentiment regarding bullishness? I think the markets are bullish, but that's not price point. They're bullish with regard to the destination of capital. When liquidity conditions return, there's an obvious destination for capital. I think the crypto markets are going to significantly outperform. But the problem is you need the liquidity conditions to return. But when the liquidity conditions return and capital starts to deploy, they're going to go to destinations that have outperformed and are expected to further outperform, which means we're going to get a significant amount of capital inflow into the crypto markets, just as you will other markets like NASDAQ and the S&P. But I think you'll have proportionally more directed towards crypto markets in future liquidity cycles because of what we've seen technologically and offerings from a product perspective. On the other hand, within crypto, what has been the last real breakthrough in crypto after DeFi? Well, DeFi is a generalization. What's pertinent is collateral, credit, money printing, permissionlessness, and disintermediation of cash flow is significant from a value investor standpoint, from a dividend investor standpoint. And most importantly, immutability, the invalidation of boards, human subjectivity, and that changes everything. So that it's not just DeFi is a very condensed and short-sighted terminology. What's pertinent is these traditional financial systems that have been revolutionized in crypto terms. Changes everything, the disintermediation of cash flow. You no longer have sticky-fingered executives or human resources or real estate or supplies, CapEx in general. It changes everything. Phantom looks a bit troubled given all of the multi-chain issues. Oh goodness, what a catastrophe. Be wary of the L2s, especially in these market conditions. Sentiment, psychologically, you'll have more fear in smaller markets with less liquidity. Less liquidity means more volatility. Sure, you have a capacity to outperform, but expect the liquidity to drain. So directionality for all assets will be depreciative because people will be capitalizing financially to mitigate their risk, their exposure to assets that they know are volatile because they just capitalize significantly to the upside. And what happens is you'll see that in the capital outflows from the L2 markets. For instance, mainnet is up 1%. You go to Arbitrum is down 2.38%. Polygon's actually marginally positive. Avalanche has seen some inflows, but bear in mind this is a marginal $1.28 billion ecosystem. Even if you go over to Optimism is micro, $607 million negative sum game. When you see a negative on the week-over-week change in liquidity conditions, that implies either a negative, zero, or positive sum game. These are the amount of currency units you have access to, and everyone is trading or investing, seeking more of the currency units that are available in circulation. That's the entire game. The game is scored in currency units, and your objective is to acquire more currency units vis-a-vis various activities and investments that can be taken. So when there's less currency units, you literally have a capacity to acquire less currency units. There's less available for you to get your hands on. Heath, Cap One Bloomberg Terminal. I do enough on TradingView, but a Bloomberg terminal would be very interesting. You get access to significantly more technical data. I don't necessarily need it because I don't need access to those equity markets or international markets. Um, and I think I have enough with regard to various rates, SOFR rates, and stuff like that. TradingView does offer a fair amount of information that most don't look to, but definitely are useful. Akita, Hermes, hi, hey, uh, uh, yeah, I like it. Or very sexy prices. Let's see. I've seen some depreciation. Wasn't that $1.60? Hey, look at that wick down on the daily. Big rip down today. We had this the depreciation towards the end of last year into the new year on the 10th of January. Look at this price region. It's getting to decent prices. You start to see something like a fresh lower low at $1.34, or you see it find a little bit of support at $1.45. You can take a nibble. You know, if your target portfolio size is like 5% and you deploy 10% of that 5%, 15%, you take a little nibble. That's very reasonable. If your target portfolio size is 5% and you're deploying 10% of that 5%, I mean, the vast majority of your capital available to deploy remains untouched. So you're not significantly decreasing the available liquidity you have to deploy to markets in potentially increasingly favorable conditions as currency deflation continues to pillage these markets. Let's get in there, Raul. Mathis. Well, what about privacy? Nobody seems to care nowadays about it. COVID woke some people up. Could be a good use case for crypto. Now, crypto has no privacy, really, especially Bitcoin, especially with on chain forensics. You could easily deduce, especially when an address has interacted with a centralized exchange, where the capital's coming from. So there's very little privacy. Um, I think there's a significant room for that kind of technology to advance. Even with ZK, it's just not seamless and not obvious and simple for you to remain anonymous with regard to capital management. The only way to be anonymous with capital management is cash. Go figure. Oh, I'm sure they're itching more and more for their digital currency, so they have a capacity to know who's spending what, where, when, and why. That's big stuff. 30 people in the stream, 7 likes. I appreciate all of you. Hit that thumbs up button. Let's take a look at Move. So bond volatility, when it spikes, is going to decrease the availability of collateral for the world to print dollars. And that is a precarious condition. So this directionality, at least on the last week for Move, is supportive of decreasing liquidity conditions across the system. What you're going to want to see is in 7 days the rejection of the TWAP on the monthly. Quite concerned with the 50 SMA, 200 SMA. That'd be a golden cross from a bond volatility standpoint on the monthly. So that I don't know the significance. I don't like this directionality. I certainly will not like if bond volatility remains elevated. We're in uncharted territory with the composition of currency, with the volatility of currency. The last time we've seen a bond market this volatile was 2008. Quite different, or maybe not so. Maybe we had our peak in like February '08, it dipped down in October '08, and then we had a blow off top because this might not be the blow off top. You literally got the dip down. You could see the fractal down, 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 and down, and up, and up. And maybe it is. And maybe you see a pop back up to the 160s, and then you see continued depreciation. Overall, I question whether bond volatility coming down significantly has a significant capacity to alter the liquidity conditions of the global system. That is normal procedure. When bond volatility significantly comes down, bonds are the source for the printing of dollars outside of the U.S. Bonds are converted to currency units, dollar liability currency units, dollar liability units. I don't know, one of those words. But These conditions right here are inhibitory of the currency printing process. And when you see domestic U.S. dollar liabilities come down like they have, we're in a very precarious situation. We haven't seen conditions like this since the 30s, since the Great Depression. We've never been negative. Let's go. This is just USM2. Let's see if we go out to 6 month. You just go back to the 1960s. But back to the 1960s, USM2 on the 6 month chart is just straight up and to the right. This is the largest decline in USM2 in forever. Flat time in the 90s. Interesting. Could study this and this has an effect on the liquidity composition of the world and where the liquidity is concentrated. It's quite extraordinary when you see you can't see it go down. Anyway, so that's where we are. We're trying to assess how far could they pull back. They've broken it. It's all broken. And they think it's not broken. And they're going to have to juice the financial economy as the real economy starts to be impacted by the financial economy. And they're going to want to defend their job, so that means they can't let the system collapse, and moral hazards out the door. So they're going to continue to sustain normalcy, sparing no expense. Curve popped over the TWAP on the daily. Looks like it directionally should hold support. It would be nice to see a retest of the TWAP. And it holds support. There's about 6 hours to the candle body close on the daily. We'll keep eyes on that. That'd be a nice one. Let's go over to the weekly and see where we are. You don't have monthly data. We've shown that chart many times. But look where we are. This is quite interesting. A technical structure. This is an inverse head and shoulders. It's a very large inverse head and shoulders. That doesn't mean anything until confirmation. It is suggestive of strength at these price points because if it could go lower, it would have gone lower. But that directionality was broken with the left shoulder-ish. Left shoulder. And we'll see where it goes from here. The capital raise, when the U.S. Treasury does the capital raise to fill the TGA, that's really crunch time. 700 billion to $1 trillion removed from systemic liquidity. You'll see that in the markets. Chart-wise, can you look at convex? Let's look at that psyops. That's some sick shit. Those people are sick. It's fucked up. This is not the best chart to look at. Here, let's pull it up here. 1 second, guys. USD. Look at the perp on Bitstamp. Nope, that's definitely not looking at the perp on Bitstamp. Binance? Yeah. Tether. Bit of the same structure as curve, if you notice on the weekly chart. A bit of that inverse head and shoulders, albeit this is quite low. Neckline is tilted neckline with, I would say, a bullish bias. There's nothing bullish in the market. What you have is support, and this inverse head and shoulders would be a bottoming pattern. This bottoming pattern, you're going back to literally the middle of 22. So this is like a year of a bottoming pattern. But bear in mind, this is the story of markets is support at the bottom, and then liquidity conditions improve, and there it goes. The bottom is locked in, and you're off to the races. And everyone loves when the markets are off to the races. It's just up, down, up, down, up, down. And those will be fun times. I've said many times before, there's free money mode when directionality is upward. And the wonderful thing about the crypto markets nowadays is you basically see free money mode here in the liquidity page. When you start to see 1%, 2%, 5% numbers, positive numbers on a weekly basis, you could safely assume the relatively significant protocols are going to be up and to the right. because capital concentrates, capital flows from underperformance to outperformance, capital flows from shit opportunity that have no significance technologically or from a product offering perspective to assets that are meaningful technology and have a product offering that's significant. So we know those products. We've talked about the products, and you could speculate and throw around the 1% of the portfolio on new stuff. And 1% to 10% changes everything, but that's certainly a behavior that's much more suited for increasing liquidity conditions. Hope that helps, Talman. Uh, with regard to entry prices, on convex, I figured that's what folks are thinking. It's, you know, I can't even think about entry. I'm overwhelmed with the debt ceiling resolution and it draining liquidity conditions as the TGA gets filled. The TGA, you'll see this come down significantly. You'll see because it's Fed balance sheet minus RRP minus TGA is domestic, synthetic liquidity conditions, you could call it, which is another perspective on liquidity other than USM2. You'll start to see this significantly break down once they resolve the debt ceiling and the TGA starts to fill. If they fill the TGA with a half a bill or a trill, you'll see this come down significantly. It's just the bottom line. Jesse, sorry, I'll be right back. I have to deal with these Fed minutes and a few positions. Yeah, we'll see what happens with these Fed minutes, but just, there's nothing to do. Just get your cash flow on a weekly basis, protect your cash, save your cash. In a deflationary environment, cash is everything, because in a deflationary environment, everyone's broke, and those with cash are king. And you're able to do everything and buy anything because everyone else stops buying everything and anything and prices start to become reasonable. Listen, if there's inventory that's unsold and a retailer needs to move inventory, that's when it goes in the clearance bin. And they're getting rid of a lot of stuff because it's just sitting on the shelves because they have excess inventory. Everyone talked about that, the bullwhip effect of supply demand on excess supply in the system. So they'll have to evacuate liquidity. Imagine if these liquidity conditions head into the end of the year, with Christmas season approaching, and the holidays in general. There'll be, I expect, significant discounts to move excess inventory to a public that is completely broken, strapped for cash, with 60+% of the population not having $1,000 to do anything with, living to paycheck to paycheck. So that's the deal for the Wednesday stream. I hope it gets everyone up to date a little bit. We need more information to make some better assessments for the directionality of the market in the midterm and the short term. We have pretty much a good sense of where things are, and it's just patience. And if there's an opportunity with like a ridiculous capitulation event, like if 10% of holders of a significant asset liquidate, drop in price 25%, all right, fine. Maybe you got a good opportunity. If they're forced to sell. And that's interesting. And I think there'll be a couple of those types of opportunities. But patience, and you'll do well in the upcoming cycle. See you on Friday. It is 1:56 p.m. Thank you all for joining. Tell everyone to subscribe, and you know the deal. After party on Discord for the most rational community in the entire crypto space. Hit those thumbs up buttons. See you next time. Peace.